Today's episode is brought to you by Blockfills, powering digital trading. Very happy to welcome back to Forward Guidance Vincent Deluard, Director of Global Macro Strategy at StoneX Global. Vincent, how you doing, man?
Good. Very happy to get a chance to catch up with you. I love your work, and I mean, man, you've been on a tear lately, so I'm on it.
Thank you. Well, I've been putting out a lot of content, but I make a lot of any macro calls, so hard for me to be on a tear. You do make macro calls, and that, Vincent, let me just say, it's a very tough business because you could be the best in the world, and 55% of the time you're still wrong. But you are on a tear. You have had a hot hand, Vincent. Last year, let's say the fall of 2023, everyone and their mother was forecasting recession in the U.S. in 2023. You stood very, very in the very small camp of people who said, actually, no, there's going to be not a hard landing, not even maybe a soft landing. There's going to be no landing. And that view, Vincent, has aged extremely well. Real GDP is now casted by the Atlanta Fed for the third quarter to be, I think, 5.8% real GDP growth. So incredible, robust resilience. I don't know if those words are strong enough. And yet, Vincent, now that the consensus has moved to your side of the camp, is it my understanding that you actually think that there will be a recession in 2024 and your growth expectations are lower than the consensus? Do I have that right?
Directionally, yes, but I'm not sure I am quite ready to make the call for the 2024 recession. Let's just say that it's something, as you mentioned, in late 2022, I was like, no, there's not going to be a recession. Even after the regional banking crisis, I thought, people were jumping the gun too fast. So I want to be mindful not to make a call before I have all the relevant data. All I can point to is that a lot of the reasons that help the economy withstand 2023 are going to turn. I call it the stealth stimulus. There was about $1 trillion that somehow economists missed. $1 trillion stimulus that really helped the economy this year, and a lot of that is going to reverse in 2024. The reason I'm not confident enough to make the recession call is because I think we've been surprised by the resilience of the economy many times before. I have this view of the Great Reset, that we have reset to a higher level of growth, higher level of inflation, higher level of rates. And in this context, what may have caused a recession before may not be enough. So for now, I will stick with the idea that we're going to have a slowdown, which I think from an asset allocation perspective is probably all that matters. And then we'll jump the gun in 2024. When the data actually comes in, we'll see. I mean, we also have a lot of political uncertainties there. But I'm certainly a lot less optimistic on U.S. growth than I was 6 months ago.
So I want to ask you about that $1 trillion of stealth stimulus. But first, what do you mean when we say Great Reset?
2010s, we had a period of low growth, low inflation, low rates, and then I think this was primarily because of the dominance of monetary policy over fiscal policy. That's kind of a driver of that and demographics. And I think we have the exact opposite situation in 2020s, dominance of fiscal policy. Monetary policy is subservient and will be increasingly so. And when fiscal policy dominates, that tends to be pro-growth, pro-rates, pro-inflation. And I would actually argue that's a good thing. It's the economy trying to heal itself. I think that's kind of one of the originalities of my view when it comes to inflation is that I'm not trying to sell gold bars or scare people in thinking that the world is ending. I've never thought the 2% target was a particularly smart invention. It's somewhat arbitrary, and at times it should probably move. And as long as it doesn't move too high, too fast, we seem to have avoided. There was a risk last year. I think the economy will be okay. We'll have better growth, better generational relation, maybe even less inequalities at the end of the decade. I mean, the only problem, of course, will be for asset prices because obviously the world looks very different if you're talking about sustained long-term rate of 5%. I just meant a permanently higher plateau where I think economic expansions will be longer, recessions will be shorter. And the main problem, in 2010s, we had underemployment of resources, right? We didn't have enough investment. We didn't have enough labor. And we had the opposite problem, which we see in the economy, right? We have too much investment, too few workers, and that's going to be the constraint on the economy. So that's what I meant by great stat.
Okay, so yeah, the past decade after the great financial crisis, high unemployment, low inflation, and the next decade will be a reversal of that. So, Vincent, what is the stealth stimulus that all the economists missed when they were forecasting a recession? $1 trillion was in the economy that you noticed and tracked, but most economists didn't. What did that comprise of? What contributed to it? And then why is it going to be no longer the stealth stimulus?
Yeah, I think the reason I paid more attention to these things is, again, because my focus is on fiscal. I've always been a believer that fiscal policy is way more important, at least when it comes to economic growth, not necessarily asset prices, but economic growth and monetary policy. And I think most economists have their eyes on the Fed and monetary policy and QT and all that stuff. So they, it's, I don't know, you remember that YouTube video where you see a bunch of basketball players passing the ball around and you look at the ball and you don't see the gorilla that's crossing the field. Uh, that to me, everybody was watching the ball, which was Jay Powell, and then the gorilla was what's going on with fiscal. So let's break down the numbers. The first thing that happened was actually announced on October 15, 2022, which was not uncoincidentally the day that the stock market bottomed, and it was a cost of living adjustment for Social Security of 8.5%. Now there are, 67 million people getting Social Security, about $1.2 trillion in annual spending. So you slap almost a 9% increase on that. That's, $100 billion. That gets credited at the end of the month and everybody's checking account. And keep in mind that these are people who own their homes, who, typically I think the median benefit is around $2,000. So it's not like giving money to Jeff Bezos where, what is he going to do with it? Right? That was another issue with the past 10 years. The wealth effect is not very powerful, but if you give people to money to lower class or middle class people, it actually gets spent. So 100 billion there. Second thing was the exact same mechanism. So the reason COLA cost of living adjustment was so high was because it was based on inflation last year, which was very high. And that's, by the way, maybe we'll get into my theory of waves of inflation, but I think that's one of the reasons why we have these wave patterns, because we have many things are indexed on inflation, but with a lag. So when inflation falls and you get the adjustment based on the past with high inflation, you get an actual stimulus, and that reignites a second wave of inflation. So Social Security works like that. The other thing that works like that is the tax brackets, right? So when you have high inflation, typically, if you do not move the brackets, you have something called bracket creep, because $110 is the new $90. You switch to a higher bracket and the government gets more which happened in 2021, 2022, where you had this huge boom in tax receipts. But in 2023, they adjusted the brackets by 7.5%. So effectively, that was a tax cut. That was almost as big as a Bush tax cut, just from the bracket adjustment, which was, again, much higher than inflation, right? 7.5% bracket adjustment. Inflation now is about 3%. So that's the second one. The third reason, I think this one economists kind of got it, of course, because it was obvious, was the CHIPS and IRA spending package. Between the two, you have about 500 billion. Let's say they spent, 150 in 2023. And
that's Congress, CHIPS Act, and the Inflation Reduction Act.
Yeah, a big
that one was the fat pitch economists noticed. But just to explain the first two, so Social Security and other programs in the U.S., they're cost of living adjustments, so they're adjusted for inflation. So when inflation goes up, how much money you get every 2 weeks or every month goes up as well, and it was adjusted for 7% in 2020. 8.5%, thank you, in 2023, even though inflation, it was lagging from the huge oil spike of 2022. So actual realized inflation for this year probably is going to be 3 or 4%. So there was a real inflation adjusted increase.
5% real increase. It's huge.
Yeah, 5% really increase. Thank you. And then this income tax bracket adjustment, I haven't heard about this before reading your work. So if you make $50,000 and then because of inflation, you get a wage increase to $60,000, you'll be in a new tax bracket. I'm just making the numbers up, and so you'll actually pay more in taxes. But if the government raises the tax brackets, which they did last year, that is a huge
extra income doesn't get taxed.
Yes, that is a huge tax cut. So actually, is it the tax cut raising the tax brackets, that's equivalent to the 2018 Trump tax cuts. That's what you
More
found.
or
I mean,
less,
that is
yes,
an
yes.
astounding statistic.
Yes, yes, yes. Because it was more than inflation, right? There was a real gain for workers, which in a way
Yeah.
offset a real loss in 2022. Again, it's always with a lag. So that's why when inflation is volatile, this volatility is like echoes. You scream and you hear your voice back, like that will carry through for many many years.
Yeah, so it wasn't a tax cut. It was not a tax creep hike in nominal terms, but actually nominal wages went up. So in real terms, it was a effective tax cut.
Yeah, correct. Yeah. And then the chips and IRA. So it's basically all the fabs that we're building in Ohio and Texas, and the way these bills, especially the CHIPS Act, are passed is a huge incentive for companies to front load if they want to maximize the value of the tax credit. So they really set it up. Usually fiscal spending, comes with a lag. I still remember the shovel-ready stimulus of Obama in 09. But here it actually worked. It was well designed. And you've certainly seen it in, if you look at the private sector non-residential investment, just through the roof this year. So that was the third one. Fourth one is it's almost like an MMT argument, but which is valid, is when you raise rates and you have the Fed that pays interest on its balance sheet, you're effectively creating money. So the Fed there's about 3.5 trillion in bank reserves, 1.5 trillion in the RRP. So 5 trillion gets credited every time the Fed increase rates. The Fed has to pay more on the liability side of its balance sheet. And 5 trillion at 5%, that's 150 billion in interest that money creation that you didn't have in 2022. It's even though it was zero. And then the last part of the stealth stimulus is the treasury channel. So the interest expense of the U.S. Treasury increases, the servicing cost of the debt increases. It's now, I think, the second or third largest fiscal spending area of the budget, 10% of the budget. Refinancing your debt at 5.5% versus refinancing it at 2% makes a big difference. And effectively, it's a transfer from the public sector to the private sector. You can think of it as, almost a UBI for the wealthy, right? I mean, you just have your people who have money market accounts, CDs, just straight out treasuries, just making more money by, the magic of fiat.
Yeah, and the Federal Reserve, there's something about so many of the Federal Reserve's assets are low yielding assets bought in 2020 and 2021 from quantitative easing. And now, so that's what they're getting on their asset side. On the liability side, they're paying very short-term liabilities, reverse repo, excess reserves, that type of stuff.
No, if the Fed was a commercial bank, it would be SVB. Right?
So, yeah, Silicon Valley Bank. It would be done.
Yeah, because they bought a bunch of mortgage-backed security and treasuries in 2020, 2021. That's when the big increase in the balance sheet was. They were getting paid 1.5% on that, and then the liability side of the balance sheet resets actually faster than SVB. Because as soon as they increase the Fed funds rate, they pay that on excess reserves, or they pay that on the reverse repo rate on the RRP. Now, the big difference with SVB, of course, is that depositors can't move. There's no alternate Fed they can turn to, and they don't have they don't have to balance the book, right? And they don't, by the way. If you look, there's just a plug on the Fed's balance sheet. I mean, that chart has been circulating on ThinkTwit on remittances due to the treasuries, which used to be like quite a good amount of seniorage income every year, and that just collapsing, usually negative. That represents net payment from the public sector to the private sector.
Yes, and if you think of quantitative easing as kind of a stock buyback for the government,
Yes.
which it is if you merge Treasury and Fed, which they're
Yes.
not the same, and MMT likes to do that, which I sometimes have an issue with. But it's about the price at which you buy it back. If you're a overvalued stock doing a stock buyback, it's not good for the intrinsic value of the business. But if you're an undervalued stock, you want to buy back the stock. So if you buy back U.S. Treasuries at an intentionally overvalued level, when interest rates are at 1%, or the 10-year Treasury is at 1% or something, short-term interest rates are at 0%, and then they go to 5%. So if you do QE when the 10 years at 1%, and you do QT when it's at 5%, that is a bad for the fiscal
Yes,
coffers of the U.S. government. But
correct.
what's bad for the fiscal coffers of the U.S. government is good for the
It's
private
good for the
sector.
economy. Yeah,
Yeah.
it's stimulant. Yeah, and that's the reason why the deficit is so much larger than people thought it would be. Because you had all these sources of extra spending that they didn't account for. They're almost running $1 trillion in surplus, which is sorry, in deficit, in excess deficit compared to what the CBA was in the baseline, which is where I get my number from. And yeah, $1 trillion that will keep the economy going.
So this is hidden stimulus, but what about the tightening effect that everyone anticipated from higher rates and quantitative tightening, but mainly higher rates of, when interest rates are at 0% and a mortgage costs 3%, there's going to be a lot of housing activity, a lot of realtors, a lot of building. When they raise rates to 5% and mortgage rates go to 7%, that's going to be a freeze. It's going to be a freeze on interest sensitive sectors. So housing, autos, and when you raise rates, you slow down the economy. Has that happened? Did it happen, but not by as much? And are you in the camp, Vincent, of, oh yes, we've gotten all of the interest rate hikes, the whole variable lag, all the effects have already been seen, or are there still effects of that tightening that are going to come in the pipeline?
More the latter. I laugh when you mention long and variable lags because it's one of these overused sentences that like what does that even mean? It's like whenever I hear power, like the long and variable lags. So, yeah, eventually we'll have a recession. But by the way, I make fun of it, but I know they will be right at some point. Like I'm not claiming that you can tighten policy by 500 basis points in 12 months and just whistle past it. So yeah, it's going to happen now. You have many guests on your podcast that explain why that hasn't happened as fast as it normally have. It's probably because people refinance so much of the liability in 2020, 2021 when rates were so low. They had this incredible liquidity position. And by the way, I think this is why, one mistake that we made is I think a lot of that recession crowd was looking at 2018 as a precedent, and then okay, when Powell's hiking and then it broke things when 2% on the front end, and not that high. So like, oh, the economy cannot take higher rates because we're highly leveraged, and that's price dependent and all that stuff. Well, there's a key difference between 2018 and 2022 is that we had this 5 trillion of stimulus happening at the same time and this massive refinancing boom. So the people were a lot less constrained by these rates, and they had the ability to kind of wait it out. Just when you see that in the real estate market, right? People are not selling their homes because if they had to sell, they'd lose the 2.5% mortgage to refinance that and have to take a 7.5. So in a weird way, it actually stimulated new homes, right? Because all the demand now goes on new homes. That creates a construction boom. That accelerates the economy. Now it's eventually, people get divorced, people die, change jobs, so things will reset, and that's kind of part of my case for 2024. At some point, it will matter. Same thing if you get the corporate side, the duration on junk bonds on average about 4 years. So we had this big issuance spike 2020, 2021. You're going to have to refinance a lot of that 2024, 2025. And this is when your jump interest expense is going to be huge. And then maybe then you'll have margins will get squeezed even more than they are now, and people will have to fire employees, and so it will happen. But just I think people are the timing of it completely wrong.
Mm-hmm. And so how does that? So do you think there's a lot of tightening that's still in the pipeline from 500 basis points? So does that mute your outlook on economic growth? So you think that's why you think the economy will slow?
Yeah, so that's one reason. I don't think it's the major reason is the opposite of what we discussed about the stealth stimulus, right? So 2023 we had falling inflation coming from high inflation, so you had real gain from your COLA and your income tax bracket adjustment. Yeah. I suspect 2024 is going to be the exact other way. Right now it's a miracle, right? Inflation is gone, right? I don't believe that, but at least the CPI, is was at 3% in June. So everything, I think the quota stuff is going to be announced fairly soon, and it's going to be around 2.5%.
That's cost of living adjustment.
Yes, yeah. Yes. I don't know what the bracket is going to be, but something like that. My base case is that inflation will reaccelerate to 4 or 5% with which I think is where it really is, always has been, always this will be for the next 5 years. So we'll have the opposite effect in 2024. We'll have people having less of a pay increase, less of a tax cut. So that will squeeze their income a little bit. We'll also have, on the fiscal side, we'll still see the spending, but remember on the fiscal policy, it's really the impulse, right? The delta. So, so the delta was huge. Now we'll just keep doing what we're doing before. So the delta will be close to zero. The Fed's payment on its liabilities, if the Fed does cut rates, like the market's pricing, that's going to drop. So you have all these sources of stimulus that are going to reverse. Another one that I wanted to mention, which I found pretty interesting. Look at spending, state level spending in California, Florida, South Carolina, and Michigan this year and last year. And I'm not taking these states as random. I mean, they all have governors that are, two of them are waiting for Joe Biden to die. Two of them are waiting for Donald Trump to go to jail and to run. So in all these four states, spending in Florida was up 41% last year, state spending. In California, it was 2022. It was up like 50%. Same thing in South Carolina.
What's the spending going? Where's the spending going?
I'd say buying votes. But no, it's just like, pay raises. A lot of, in Florida, they had big increase in civil servant wages. California, where is this? I don't know. You have, I think, 50 million Californians are asking the same question: where do my taxes go? I don't think anyone has the answer here. It's been a great mystery, but the money certainly goes. The point is, you had all these governors who were, preparing their run, and then 2024, of course. I mean, they're gonna have to squeeze it in, right, to get it out. So that's another part of the stimulus that's going to go away.
How have you made sense of this momentous stock market rally? So I guess economic growth has been a lot better than expected, and inflation has fallen. Is it more complicated than that?
I'm afraid not. I must say I've kind of missed that. I think now I like the way the market's been acting in the past month or so. But I thought going into 2023, I thought, okay, like the economy is going to do well, but rates are going to have to go higher. And if rates are, 5% on the 2 years and 4.5% on the 10 year, like, it didn't make sense to me that we'd have a 21 multiple on the S&P 500. But it did. And I think it's kind of this, it boils down ultimately about the path of inflation. Like the market, I think, was able to rally because the narrative was this was the immaculate inflation, right? Inflation is going to slow, growth is going to remain strong, and if inflation never comes back, it's great, right? It's wonderful, right? The GDP now is 5.8%, inflation is at 3%. We live in the best of all worlds. So in that world, maybe you should pay 400 times 400 years earnings. I don't know. My view is that this is not the world we live in. Eventually, this inflation dynamic will come back, and you'll need your long rates to move higher, and that will really put pressure on valuations. And I think that's what we are seeing right now.
I'm here today to tell you about Blockfills, a crypto trading solutions and financial technology firm founded in 2018. Since then, Blockfills has been ushering institutional investors into the digital assets marketplace with their array of services, providing liquidity, prime lending, their over-the-counter desk, which is prolific, their industry-leading SaaS suite, and their market-leading electronic trading venue, which provides unprecedented speed, ability, and flexibility. Importantly, Blockfills' electronic trading venue has no hidden fees and offers much better connectivity, pricing, and technology. That's why it's the premier destination for liquidity providers and professional consumers in digital assets. Learn more at blockfills.com/trading. Thanks, and let's get back to the interview. Why do you think inflation fell so rapidly, and why do you think it won't continue? Tell us about the second wave of inflation you see coming.
Right. So first of all, I like to distinguish between inflation and the CPI. With everything, whether it's we have the measure and the reality that we're trying to measure, and we try to make the measure as close to fit, but the measure is always a measure. It's not the reality. When I think about inflation, I think of it more holistically as a social, political, economic, cultural, generational phenomenon that plays out over decades. And that's why I believe we are in a high inflation environment. Now, in that high inflation environment, in every high inflation environment, there are periods of disinflation, periods of inflation, as measured by the CPI. And we are in a period when the CPI is falling. In some ways, it is falling. The fall is as fake as the rise to 9%. When we were going to 9% last summer, it was because of the Russian invasion, base effect, used car prices, airline tickets, a lot of idiosyncratic factors. And then these idiosyncratic factors reversed. So we went from 9% to 3%. But if you look at the super sticky stuff, which to me is wages, at the end of the day, the inflation to me is the marginal cost of labor. And wages have been growing at 4 or 5% for about 3 years now. And I think that's a healthy thing. That's a very good thing. And I think it will continue. Now the CPI may not reflect that right away because, as everybody knows, is shelter is 50% CPI and it's live and yada yada. One thing I would point though is that healthcare suffers from many of the same biases as shelter, but people don't talk about it as much. And healthcare, the opposite effect of shelter. So right now, shelter is falling, and will keep falling. I think healthcare has been right now. There's supposedly disinflation in the healthcare supply. Healthcare is cheaper in the U.S. now than it was last summer, which is not true. It's all statistical quirks, and that's going to go away in November. That would be one possible driver for inflation to come back. Maybe you get another 2 or 3 good prints, and then inflation starts to pick up again.
And so, base effects are when you measure something on a year-over-year basis. You get certain quirks. So, in June of 2023, the consumer price index, which includes oil as a huge and volatile component, was only, I don't know, you tell me, 3%, pretty close to there, but of an increase. But true inflation is actually a lot higher on a month-over-month basis, 3-month change over change. It just so happens that a year ago, the price of, in June 2022, the price of oil was at $120. That's the most dramatic example of it. So going forward, what is shaping your outlook that inflation is going to reaccelerate and remain high?
In large part, it's historical experience. And so I've had a bit of fun with the Bank of England data. They just published 1,500 years of economic data, which take with a grain of salt, right? Black plague, trade balance, I'm not sure. But anyway, still fun to, because one of my issues especially in the yield curve conversation, right? Anyway, you testing this on 10 recessions, it's like you have a million possible indicators and you test them on 10. Generally, I think the big problem, one reason why, so much of finance is talking heads and non-scientific is because the inability to test over long samples, which is why, for all its flaws, I like the long-term data that the UK has. And so I wanted to test a hypothesis. I looked at it, and I think a couple of hundred inflation episodes, I found this very sine-like wave pattern for inflation. So you have one shock, and then 2 years later an equal shock, 3 years later another one. Now the relative size of the shocks, may be different. Like in the 70s, they were ascending waves, right? 71, we go up the dollar sign were the first wave. 73, the first salt shock. 79 is the big one. So 3 ascending waves. In the 40s in the US, we have a first wave when the US mobilized for war. Second wave when the price control go off after victory. Third wave when the Korean War picks up, and then post-Korean War recovery, we have it. But the point is, you kind of always see these little waves. And then I can go back to, for example, like one I looked like, because I like that period, was the War Spanish Succession, because that corresponds to the founding of the Bank of England. And there you have also like 5 successive waves over 10 years. So that's the main reason why we did it, because historically, that's why inflation doesn't especially now that we have these effects that I was talking about, since we index stuff on inflation and there's this lag building in the adjustment, you repeat. It's kind of almost like if you look at demographic pyramids, like the missing generation of the war, and then 25 years later, you have a missing generation because the kids the kids haven't been born from the parents who are dead. It's kind of the same thing with inflation here. And what I find stunning is that the swap market is not pricing that at all. You look at break evens, you look at swaps, there's no second wave. And it would be very unusual for inflation not to have this kind of wave like that.
Yeah, so swaps, inflation break evens, those are market expectations or market pricing for what inflation will be in the future. I think the market is as young as 2004, so literally 5 years younger than Bitcoin. So, when people talk about it, it's not like they're taking about their ancient finance book that's been, this storied thing. And obviously, the tips market exceptionally wrong in 2021 when it, forecast, inflation break evens to be 2%, 3%. It was not 9%, which it actually was. And then what was I going to say? So yeah, we can, and if we haven't already, we can put up that chart of looking at your regression, your analysis of Bank of England data. When inflation goes up to 7%, what does the following months look like? And when inflation goes to 7%, on average, it declines quite sharply, but after that, it stays somewhat elevated. And this effect actually is not tremendous from 1200 to 1918, but since 1918, inflation, you've had a multiple echo of peaks after spikes. So it peaks and then it goes down, but then it peaks again.
It would not have, escaped to scrutiny that for much of that period,
Gold standard.
The gold standard, and also I am looking at the more serious global bank. The pound became the global reserve currency, and you could say that Napoleonic War. I would actually put that even before. So I'm looking at actually a very serious central bank issuing a very good currency. If I included, Latin America in my sample or Eastern Europe, you see even crazier waves. So even in the best of times, when you issue the world reserve currency, you tie to gold, and your navy rules the oceans, you still see this back.
So, but the market is not pricing. The market is pricing in a stubborn return to 2%.
We don't see how we don't have inflation at 4 or 5%. It's a fiscal argument at the end of the day. From emerging market finance people know that if you want to keep a stable debt to GDP ratio, you need nominal growth to equal your deficit, right? Because otherwise your deficit grows faster than GDP. So over time, your debt kind of explodes. You pay more on your interest, and you get this kind of like death spirals like Argentina has, every 5 years. So in the US, what is our structural deficit right now? It's 6 to 7% of GDP. We have full employment, and we have 6 to 7% of GDP in deficit. So what's our real growth? I don't think it has changed all that much in schools. I'm not pessimistic. I think we can go at 2% real, but between 2 and 6%, something needs to fill the gap. So either you're going to have to shrink the deficit, which we know is not possible. We're not going to shrink social security. We're not going to, cut military spending. Or you can just say, well, for a couple of years, yes, we'll let inflation run a little bit hot. And that's not the end of the world. And again, let me stress this idea. So initially I just did in the US. I tested the distribution of growth versus the level of inflation in the US since the 19th century. And what I found was historically real growth was highest when inflation was around 4%.
About 4%.
About 4%.
About 4%. Yeah.
Yeah. So basically, you have kind of this smile, from inverting smile, right? So when inflation is too low, economy is depression, growth is bad. When inflation is too high, you have Argentina problems. Inflation is, it's a cost, right? You cannot make long-term plans. You have to spend time changing the price. So, but in that middle, there's nothing special about 2%. That peak is actually closer to 4%. And I was wondering, well, maybe my data is wrong. Maybe I just did in the US. So I reran it in Japan, in France, in Germany, and the UK. And I found the exact same thing. That growth historically, and these are very different economies, different histories, cultures, norms, and all that. Historically, growth is stronger when you have 4 or 5% inflation. And this is something that I think, for example, emerging market central bankers, they know that. Like, if you look at most emerging market central banks, they target 3-4% inflation. Why do they do that? Because they know they want to catch up, and they know that as they catch up, wages tend to rise, credit expands, and growth is inherently inflationary. So going to a higher target, I think, will be quite positive for growth. And you could make the case that actually that 2% target was too low.
Well, they only adopted it in 2010, around there, and the U.S. the Federal Reserve adopted it. Before then, it was just, low inflation, whatever that meant, and people had their own
interpretation. So in the Federal Reserve Act, it's a stable prices, and then the big innovation, if you want, what was to define that as a stable rate of growth in the prices, which say is dysfunctional, but as long as you have a consistent 10,000% inflation, that would fit the mandate. But yes, the 2% is relatively new. My impression is that it was adopted in a way because it was easy, right? Inflation was falling anyway in the 80s, 90s. I mean, we talked about in prior interviews where we talked about the Mexican migrants coming in, the China shock, the excess savings of Europeans. So you had this perfect environment where inflation was forming on its own. So you could, if at times it was even too high, right? Europe could not hit it. In the U.S. for 6 years, it was below 2%. But it was more of a convenience than it was a scientific decision. I mean, a lot of economists have argued, and correctly, I think, that it's probably too low because you can form the zero lower bound trap. It's you don't have enough of a buffer. And I would also argue that I would submit the proposition that maybe we don't need an inflation target at all. Because when I think about inflation, I think inflation is ultimately the pace of wage growth, right? Because all economic output is labor transformed. So if we put a target on the price level, we effectively put a target on the wages. And why do we do that? That seems very Soviet to me. If we did that to capital, imagine if the central bank said, you know what? No, interest rate 4%. That's it. That's a good number.
But perpetually they targeted.
Yeah, why? I mean, there is supply and demand for labor just as well. There are times when labor is scarce, and when labor is scarce, you should pay a premium to have it. And right now is such a time because we have less immigration. We have a small generation of Gen Zers entering the labor force, a big generation leaving the labor force. And so we should the relative value of labor versus capital should increase so that people can start buying homes again, making babies, having good middle class lifestyles, and so forth. And by keeping it low, I think we've done economic harm. That 2% target, you can think about it as some form of a straitjacket that we put in the economy.
So when you have a 2% inflation target, that means that unless inflation is at 2% or headed to 2%, I mean, if it stays at 3%, we're pretty close to 2%, then the Fed has to keep on raising interest rates. Why do you think a higher target would give the Fed more flexibility? In other words, if the Fed keeps at 2%, what's wrong with that?
What's wrong with that is that we're gonna have a fiscal problem. We will see, if we keep deficits at 6% of GDP, and our inflation is 2%, so nominal GDP is growing by 4%. So every 2 years, we're adding 2% to the debt to GDP ratio, and eventually, more and more of your budget gets eaten out by interest payment, which feeds on itself. A high interest payment mean a bigger deficit, and so forth. And we're gonna have to cut other things, because we're gonna have to service the debt. And this is self-inflicted. I mean, I'm not saying, well, I am saying it's kind of boring, I guess, but I think this should be a topic of public discussion. Okay, what is the worst? What is the best outcome? Do we want I don't know. Some people, there's a good case to be made for low inflation as well. Do we want low inflation, or do we want to have cuts to Social Security? To me, there's a generational aspect to this. If you're old and you own assets, you would want low inflation and low interest rate and high asset prices. If you're young, you want high wage growth, low asset prices. So there is a generational element to this conversation, but I think this is a conversation that should be had in public. And I don't trust that the FOMC doesn't have a mandate really to decide for uh, things that really impact the lives of millions of Americans.
Well, it does have a mandate. You're making the case that it shouldn't have the mandate.
I guess.
So what about the risk, though? And this is, I think, something the Fed thinks about, that if you raise the inflation target, that the long end of the yield curve will get unanchored. So actually, debt payments will cost a lot more for the U.S. government, and inflation expectations will get unanchored. So, inflation is psychology. As when people's wages go up, they'll spend all of it, and they'll borrow as much money as they can to buy real assets, because anticipating that they go up in nominal value, because the currency is being depreciated, and inflation becomes kind of a self-fulfilling prophecy.
Yeah, that certainly has been the experience in many countries, like Latin America comes to mind, and that is when inflation becomes harmful to growth, right? Because it encourages hoarding, speculative behavior. I don't think we're you don't want to get there, right? But I don't think we're there. Inflation expectations, as far as I can tell, are very well anchored. We issue the world reserve currency, and I think the inflation that I'm talking about is the good kind of inflation. At least I'm hoping it's inflation coming from wages, from economic activity, not the kind of sterile, excess money printing, um, spent to like politically favored groups. So I mean, this is turning into a policy discussion, which I did not expect. But I think one way to deal with that would be to have a very good kind of pro-market, uh, antitrust competition policy to make sure that you maximize economic efficiency at the same time. I think you really run into problems when you have inefficient economic structure, money printing, and then that's when, like Argentina, Venezuela, that's when, like, okay, people realize, okay, this is going to hell. Let me buy some gold or get out of the country. But you can have periods of in Europe, that was the Trente Glorieuses. In France, the 30 glorious years between 1945 and 1975, all across Europe, in Japan as well, where you had high growth, high inflation, high productivity, low inequality, and generally economies that were getting more efficient. And I think if we want to do this great reset properly, yeah, I'm using the great reset as a political term, with a new generational bargain, I think that will be the path. I'm not saying it's going to happen.
Moving back towards inflation, how do you square what's going on in the U.S. banking system with your inflationary view? Loans and leases in bank credit, so bank loans, have been flat, I think, since January or February. And by the way that the Federal Reserve posts something called bank credit, and I know you know this, and that includes treasuries and agency mortgage-backed securities, which are not bank credit. So in terms of that, bank balance sheets have actually shrunk year over year. So that's, quote, monetary deflation, except it's not actual bank credit. It's just called bank credit. Real bank credit is loans and leases, and that is still up year over year, I think 5%. The rate of growth is going down, but then it's been flat since January, February. And of course, we had the failure of Silicon Valley Bank and other banks later on. I mean, banks appear to be either constricting credit or constraining the growth of credit, which are similar things. Inflation typically occurs when the monetary the money supply expands. But if banks aren't making new loans, or they're not making enough new loans to grow that, that seems to be deflationary.
Yeah, here I would recommend people look at Lina Alden's work, and you've had her many times on the Four Guidance, and I think she makes this important distinction between credit-based inflation and deficit-based inflation. And I think you need credit does not play a big role in this cycle, at least not yet. The inflation that we had in 2022 was not. I mean, yes, there was a little pickup in credit in 2021, but by and large, that was not the big story. The big story was about government spending, and that's kind of one of the reasons why hiking is not slowing inflation all that much is because we're targeting the wrong thing. In the 70s, it was. In the 70s, you look at the money supply; it was growing, double digit every. And the moment Volcker stopped the growth in the money supply, inflation went away. I'm not sure this is the same kind of inflation. It's maybe the inflation that we're experiencing right now is maybe more like what we had in the 40s, where it's not because people are taking more credit cards or companies are borrowing too much from the bank. It's because we have a real resource constraint because of our demography, of immigration, of supply chains, and because we have a government that's running a 7% of GDP deficit when we have full employment.
So, but the flatlining of bank loans, you don't think that will have a disinflationary impact, or no?
I mean, eventually, yes. I mean, again, it's kind of part of that long and variable story. Like, yes, obviously, it is more deflationary than it is inflationary, but I'm just saying it's not the primary cause of it. And as long as we have the fiscal spigot, if you want, filling the bucket, yeah, we may have a little leak from monetary, but more water comes in and comes out. We're still in this inflationary world.
Right, but you expect the spigot to stop right next year, right? Because the shadow stimulus is
Yes.
going away. So
Yes.
so just paint us. Where are you on that spectrum? Are you an inflationista or not?
I remain a long-term inflationista. Yes. Short term, it's kind of difficult because you really have all these cross currents. So you have shelter that's going to drag it down. Everybody knows that. Healthcare that could drag it up. Uh, you also have commodity prices, which they're pretty high. I mean, not that far from 100. That's kind of my fear, by the way, that we'll have another spike in commodity prices, and that will kind of bring inflation higher, and potentially that would throw the economy into recession. But of course, I cannot predict when the price of oil will be in 3 months.
You can't come on.
But I worry that would be it. Then I don't know if the drop in spending will really address the shortage of labor that we have. Like for example, the cola, all that's, yeah. I guess yes, it will still demand eventually. You're probably right, but we'll still be short roofers, truck drivers. These things are. I mean, you look at the UPS guy, like I mean, or the auto workers. I mean, really, that I don't think this story is getting enough attention. Like, we are, I think, living at an epochal moment where power is shifting from capital back to labor, and yeah, there will be ebbs and flows in that process. But I'm seeing the camp that wages are going to keep growing in the U.S. at a very elevated rate uh, for the next 4 or 5 years, and of course that will be less elevated when there's a recession. But if I doubt that we'll see the kind of like negative real wage growth that we had in 2010s.
So in this new macro world of higher inflation, how do you invest? Your bond yields have already gone up a lot. I think the 10 years, well above 4%. The stock market's been a tear. So stocks have just really smoked bonds. Bonds have drastically underperformed stocks. Well, do you think that will continue? How does that impact your asset allocation, you think?
But for me, the biggest trade that I see happening in 2024 is the rest of the world versus US. And it's part of that inflation story, and it's part of that higher rate story. So for 10 years, we had the being long US equity, short the rest of the world was a gift that keeps on giving. You made 10% a year with no vol, long MSCI, short MSCI, long MSCI US, short MSCI World X US. And that was just because the US was sucking in capital. It was a place of innovation. We had the share revolution. We had a bunch of stuff, a bunch of stories that just made the US a destination for global capital. Now, because the US was a destination for global capital, we're importing capital from the rest of the world. That means we have a very negative net in the international investment position. We owe a lot less foreign assets than foreigners owe US assets. The US is a net debtor to the extent for about $16 trillion. Now, when rates were going down, this was great, right? I mean, if you have a lot of debt and rates go down, cool, take on more debt. So I mean, it's great. When rates go up, it's the exact opposite. So the cost of financing this negative position, 16 trillion at 5%, that's almost $1 trillion. So that means that these are dollars that will be converting to yen, to yuan, to euro, into dinars, or whatever, all the currencies of the creditor nations in the world. And I think that will put pressure on the dollar. And effectively, higher rates are a transfer from debtor to creditors. So at the international level, it's a transfer from the US to the rest of the world. At the same time, we are in a position where the premium for US assets has never been that as big. Obviously, the US has all the big companies. Right? You look at the list of 10 largest companies in the world, I think all of them, but Saudi Aramco are US. And reason they're so big is because they trade at 50 times earnings when their peers trade for much less. So you have this big valuation differential. You have this currency channel that's happening. And then even in my economic forecast, I think that's kind of consistent with this. I'm sure you've heard the term the dollar smile, which is the tendency of the dollar to do well when things are either really good or really bad. When they're really bad, everybody wants dollar because safest assets. When it's really good, everybody wants to buy the Nasdaq. We're coming from a really good moment when everybody wanted Nvidia, and I think as the economy slows, maybe it doesn't get to recession 24, but it certainly slows. We get to that valley in the middle of the dollar smile where US assets outperform. Sorry, non-US assets outperform. So if I had to put one trade for the next 10 years, one equity trade, be long the rest of the world, short the US.
And can you explain why higher rates are a catalyst for that? Because as you say, the rest of the world is a net creditor to the United States. So they have they're long more dollars than they are short net. But I think a lot of those US dollars that they're long are held by governments. So strong dollar doesn't really help them. It's a non-financial agent. Whereas rising rates hurts often corporate foreign companies who are short dollars, i.e., they borrowed a bond dollar. So, typically rising rates causes trouble in the rest of the emerging market world. 2014, Indonesia, Thailand, 1997, right? I mean, doesn't rising rates typically inflict some damage on the rest of the world rather than improving the rest of the world relative to the dollar?
So the answer is it's net, right? I mean, net in international investment positions. So net, the US is better. Yes, foreign corporations are born with dollars, whatever, but that gets netted out. Foreigners own more US assets than the US own. So when rates go up, I mean, of course, it's not the same for everybody, and there needs to be the linkages between. But on balance, the US is going to send more of its assets abroad to service its net debt than it was when rates were at zero. And then the point you mentioned about Indonesia, I think is interesting. Why that hasn't happened in 2022? We had what was maybe it was not Indonesia, but it may have been Mexico or Brazil. But the best performing bond market in 2022 was one of these countries that you typically think like, oh, every time rates go up and the dollar is like, oh, Indonesia is gonna take it, right? Or it's gonna be Brazil, it's gonna be Mexico. Right? Argentina is a separate basket case, but that was, I think, one of the big surprises in 2022 was that the typically vulnerable economies perform best at what you would have thought is a horrible time to invest in Brazilian bond or Indonesian bonds when the Fed is going to hike crazy. And to me, that kind of speaks to this change in when something bad that should happen is not happening. I think you should pay attention.
Or is it just the price of oil is at $100 and Brazil exports a lot of oil? I mean, Brazilian stocks did really well from 2000 to 2008 when the price of oil went up, and then suddenly when the price of oil stopped going up, it didn't do well. Right?
Yeah, there is some of that, but we can play the game. Like, why was the price of oil and coal so much higher? So much higher. I mean, in some ways, it was because of policy decisions that were made in the US. It was part of that inflation story, and they were sitting on the right. And there's an element of luck to this. I'm not luck is part of investing. I mean, I could say the same thing about 2014. Why did the dollar strengthen in 2014?
Yep.
Just because, shale gas, uh, luck exists. The US was lucky in the 2010s. I think the rest of the world is going to happen to be lucky in 2023.
Absolutely. So, what countries, foreign markets, do you like the most, and which do you like the least? And I guess I'll ask you the hardest question first, which is China. If you invest in emerging markets, a lot of that is China, and it's very hard to find a stock market that is anywhere in the world that is performing worse than the Chinese stock market over the past 2 or 3 years. It is the lowest of the low in terms of how shareholders have been rewarded. Um, and the economy's been bad, but the market's been way worse than the economy, I think. So what do you think about China?
Yeah, I think that's been one of the reasons why we haven't seen this because the story I'm describing is actually unfolding. It's the same with the gorilla in the basketball court metaphor, right? I mean, it's just been hidden by the fact that China is this huge piece of the MSCI Emerging Market Index, and it's done horribly. But if you look at ex-China, a stat that I love is over the past 3 years, Turkish stocks in dollars have outperformed US stocks. Turkish stocks, they had the coup, the crazy monetary policy. No one wants to touch them. The currency has gone to complete hell. But yes, despite that, because they have like this 15% dividend yield and the EPS growth is fantastic, right? Because the currency goes to hell. So anyway, the point is like same is true for Brazil. So same is true for Indonesia. So I would think of China more as the exception than the rule, but because of its size, it's kind of hidden this narrative that I'm describing. What thought do I have in terms of um, I, I suspect from a distance that we kind of having excess pessimism when it comes to China. Some stories that I feel just seem don't pass the smell test for me. One is that I keep seeing these headlines on Bloomberg Chat is China having a Lehman Brothers moment. I mean, anybody who kind of understand how China works, like, no, it's not going to happen because the government controls the banks. So, like you cannot have Lehman. Or the other one is like China cannot stimulate
Because it's going to depreciate its currency, which will accelerate capital flight. Yeah, I've seen that.
Yeah, but I mean, they have capital controls. They have a 25% youth unemployment rate. They have a lot of legal capacity. They primarily borrow in their own currency. China can stimulate. They have not. I agree, not to the extent that people thought. But the notion that they cannot stimulate seems quite outrageous to me. My guess also is we have some very negative news flow coming out of China for political reasons, and then maybe maybe it's not as bad. Certainly, it is slowing. The demographics are awful. There may be a balance sheet recession that's kind of unfolding there as well. So I would be, but again, a lot of that is in the price, right? The question is it going to get worse? And you look at the valuation of Alibaba versus Amazon or Baidu versus Google. It's really, really, really wide. So maybe China stops being a huge drag because people have already kind of integrated that in their forecast. And then I don't know. I'm bullish Europe, and I know this is something you should never be. I mean, I spent 15 years of my life, covering European equities and being chronically depressed because of it. But yeah, Europe has actually done very well this year in dollar terms. So I think it's going to play out a lot like 2002 to 2007, when during corrections, EM fell about the same as the S&P 500, and then they rebounded much faster. And then it was EM, it was Europe, maybe less China this time, maybe it's going to be more India. But and yeah, Europe may be a way to play on these companies, on these regions where you may not want to own the company because of policy risk, but you can maybe play it with European companies that have exposure to this narrative.
And the catalyst for the reversal of the long-term underperformance of European equities, which made you so depressed, that is just the underperformance of U.S. growth relative to expectations, relative to European growth.
Yeah, so there's this interest rate channel that I was talking
Mm-hmm.
about. It's hard for me, honestly, to come up with a very good fundamental case, long-term case for Europe. I tried. One area I would point to the banking sector. I think that's one that doesn't get enough attention. Like, one reason Europe performed so poorly for 10 years is because this banking sector was a mess, and we fixed it in the worst possible ways. And we had the Basel III, and that really choked growth. And after 10 years of pain, I think a lot of these issues have been solved, but the market is not really giving you credit. Like, you look at, European banks trade for like 6 times earnings, 0.5 times book. So as the banking sector has more or less processed this issue, I think that is the most optimistic case I can make for Europe. One thing that really strikes me, and I don't have a good answer for why that happens, but if you had told me last year, I would have thought the spreads would have blown up in Europe on peripheral debt. We had, we had populists in Italy. We had a really risky election in Spain. We had the end of TLTRO. We had the ECB doing quantitative tightening. We had rate hikes. We had big deficits. I mean, perfect combo for seeing the BTP Bund spread blow up, and one the other way. And maybe in one of these cases, as I was saying, when something bad that should happen is not happening, it's the Silver Blades, right? The Sherlock Holmes novel. What's going on with the dog? What, the dog did nothing last night. That was the curious incident.
Yeah, I think Greece just got upgraded to investment grade.
Wow! Wow!
Sign of the times.
Wow! As soon if the U.S. keeps going.
Yeah. But I mean, it has to be a pretty big reversal because the U.S. growth has been so robust. So you do expect a slowing in U.S. growth, and a slowing of the growth, not a slowing of the economy. So not economic contraction, just growth growing from 6% to 2%, not from 6% to negative 2%. And yeah, so you expect that sometime over the next year.
Yeah, I think in 2024. I mean, I was playing with historical data, and it looks like it takes about, my impression. So I call that the trampoline landing. So we had we're bouncing back on the trampoline. We have reached maximum height, and then we're gonna have downward velocity. And so it would take about 12 months to get to a recession, if there is such a thing. So that would get us to the summer of 2024. But again, I'm not willing to make that call. All that I think we can say with a fair amount of confidence is that it will slow down.
What about Japan? Interest rates there have been zero for a very long time. And if you think of a country that cannot handle higher rates, you can't imagine one more than Japan that has an immense amount of debt. But if they have inflation,
What makes you think Japan cannot handle higher? I mean, the debt is owned by the central bank. I mean, so it doesn't exist. I mean, what part of the private sector? I mean, I don't think yeah. Was
okay.
it just the public
Well,
debt?
you're going to have to print, if interest rate, you're going to have to print a lot of money to pay the interest on the debt. Right.
Well, if you'd have to first let's net out the debt held by the BOJ, because that I'm not going to that doesn't exist, right? It's just an accounting trick. No,
okay, yeah. So you're saying that there's a huge amount of debt, but if it's all owned by the Bank of Japan, it may as well not.
Yeah, like if you adjust for that, the stock of Japanese debt, I don't think is really that much about the stock of US debt, and the private sector is extremely unleveraged in Japan.
Yeah.
For 4 years, it's been deleveraging nonstop.
Okay, fair enough. So do you think? I mean, the Japanese stock market has been on a tear. Are you bullish Japan as well? And do you think Japan can get off 0% or get off 0% yield control?
Yeah, I think as a foreign investor, I would definitely play it, because I mean the risk is the reason the stock market has been on a tear is because the yen has come down, and the Nikkei is dominated by these big exporters, which are effectively being subsidized by the Bank of Japan through the exchange rate channel, also through the fact that they're just buying their own stock. every month. It's kind of crazy that they still do that. So the Bank of Japan buys like ETFs on the Nikkei every month. So the risk is that these things stop, right? That the Bank of Japan says, hey, I'm worried about inflation. Everybody else is raising rates. I'm going to keep. Well, if that happens, yeah, the stock market is going to, the Nikkei is going to hurt, but then the yen would absolutely soar. So if you're a foreign investor, what you lose on the index, you'll make back on the currency. So in a way, it's kind of a hedge position, right? If you long yen and the Nikkei, you have it hedged. So yeah, I could see it be part of as it was even in Japan performed quite well between 2002 and 2007 as well.
Got it. And so, sticking just with U.S. rather than country allocations, just sector allocations. What do you think about the technology sector, which has, richly valued, has been on absolute tear? NASDAQ up with 35-40% this year. And then what do you think about your favored holy trinity sectors, healthcare, energy, and financials?
Yeah, technology has really defied my expectation. I did, I thought they would be hurt the most by the rate hikes. It seems to be finally happening, but yeah, it's extraordinarily resilient. And I think that's a mistake I've made, and maybe I will continue to make, is underestimate the power of these big tech groups, the balance sheet, the captive markets, the political influence that they have. I mean, they are beasts. Your Max 7. I mean, maybe underweight, but not betting against them is proven to be very costly. On the Holy Trinity, the one that worries me the most as a risk for the economy again is short term is energy. I worry that we will see oil prices spike back up, and that could throw the economy into the actual recession that will force the Fed to hike at the worst possible time. So I think that is a reason to have energy in your portfolio outside the valuation argument, which I buy, but just to hedge against, I think, what is the biggest risk for 2024, which is oil price above $100. So I would still maintain a weight on energy. The one that I'm getting increasingly excited upon is healthcare. And to me, healthcare is the biggest story of the next decade, because we just the demographics, right? I mean, boomers are going to die, or they're going to be very sick, and in the US, it's very expensive to die. It's very expensive to age. So you have this
Vince, you're really bumming us out over here.
I'm sorry, I don't make the actuarial tables. Yeah. But yeah, so you have this kind of tidal wave of spending towards healthcare, and it's really this year. It's the big pharma are trading for like 8-9 times earning. Their balance sheets are reminding me of big tech balance sheet 10 years ago. Almost no debt, a lot of cash, great cash flow generation. And then I think also a bit because of the AI paradigm. I think people are doing AI wrong. They're doing the same mistake they do, buying Cisco during the internet. Or like the internet is here. I need to buy the Cisco, the telecommunication protocol. Gold rush by the shovel, right? And then of course the best play was not the one that built infrastructure on the internet. It was the one that built business that were based around the internet, like Amazon, Google, and so forth. Now, if you apply the metaphor to AI, people are thinking the same thing. I'm buying the shovels, I'm buying Nvidia. But chips, I'm not a specialist here, but eventually I think other people are going to figure out how to make good chips. But if you're able to leverage AI in order to improve the efficiency of your core business, this is the ones who will reap dividends. And to me, it's the healthcare sector. Like, think about what a health insurer does, right? It just collects a bunch of data and predict outcomes. This is the perfect task that AI can do so much better than a human. Same thing with genome sequencing, drug testing, a lot of the administrative tasks. This is a sector that is going to be very, very easy to automate. So I imagine I can see very rapid productivity gains in the sector at the same time as you have this boom in demand and very favorable valuation and fundamentals. So all this lining up to make, I think healthcare is going to be to the 2020s what big tech was the 2010s, China was the 2000s, or internet was the 1990s.
I finally want to ask you about the banking sector, but just on the S&P 500 itself, S&P since October has been on an absolute tear. However, as you pointed out, 3 quarters in a row, year over year growth in earnings has been negative. And I guess that has been because falling inflation, robust economy, but it is quite strange that earnings have been falling as the stock market has gone up, which are comprised of the future earnings.
I would agree with that assessment. It's also quite strange that earnings have been falling when we had this immaculate disinflation and 5.8%, GDP now and 3.5% unemployment rate. Got to make you wonder what's going to happen when when we actually have a bad economy. Part of the fall, of course, is the kind of the base effect. Right? We had this insane boost to earnings from the COVID stimulus. Like you especially see that the Max 7, like Amazon, taking like it's going to be hard for tech to, there's some normalization of their profit. Now, the question I think going forward is whether we will go back to this kind of 14% profit margin that we had in 2021. Which seems to be what the consensus is, and it seems to be the premise upon which that rally is based, right? It's that, okay, well, we have 3 bad quarters, but it's going to be better in the second half. Somehow it's always better in the second half.
Yeah, and so future earnings expectations have gone up. That's really what the rally is.
Right. Because, and the view is that it's margin, right? Margin's going to go back. My personal view is that this margin thing is kind of like the people projecting the all major margin, 07, 08 margins on the oil companies. Like, no, this was a once in a millennium flood type of event. It was everything, but the analysts kind of thought that with all of the banks, right, when they were hiring all the graduates at business school in 06 or 07. I think we're doing the same thing with the big tech companies. We're confusing what was a really once in a millennium flood, which is COVID, stimulus, everybody working from home, upgrading their equipment, buying online. That really pushed their margins, pushed the S&P 500 margins above their long-term trend. Now we are actually reversing towards the long-term trend, but then if you get an expectation, we're going back to 14%. I don't see how you can do that if the economy slows, interest expenses are going to rise, and wages are still growing by 7, 8, 5, 6%. Where is that margin expansion going to come from? I don't get it.
All right. So you're bearish on stocks, or you're definitely bearish on U.S. stocks relative to foreign stocks.
Yeah, that's correct. And I would say I'm absolutely bearish on stocks, at least in the short term. And I think this process is unraveling. The past weeks, it's been. I think there's something psychological about where yields are now. That people start to pay attention, and why should I pay 22 times earnings when I'm getting like 5.5 in cash? And real yield of 2% with tips, 2%. These are numbers that we haven't seen in 4 years, and maybe it takes time for it to sink in, because for 20 years we had this kind of buy the dip mentality and buy every pullback. But at some point. And I think we've reached that point.
So one of the sectors in your holy trinity was financials, and financial sector is supposed to make more money as interest rates rise because they make loans at higher yields. Has your view changed, since we've had the failure of Silicon Valley Bank as well as First Republic, or do you think actually sentiment is too negative? And you still think they'll? And also, how has your thesis aged of they'll make money as interest rates rise, given that deposit costs are going up? And deposit money is no longer free, even for the banks.
Yeah, banks have obviously not performed very well this year. At the same time, it hasn't been the absolute disaster that people forecasted, right? SVB was not the Lehman moment.
No.
And a lot of banks are still making a lot of money. Certainly the big guys are making a lot of money. Regional banks deposits are starting to stabilize there. I mean, the spreads are still pretty healthy. And I think part of the, not fully, but part of the problem is the assets get written down as rates go up, but the liabilities for banks deposits uh, doesn't get written down at the same time, right? So that kind of creates the illusion that there is this kind of imbalance. But you can almost think of it as especially like a bank like JP Morgan, they're always going to have deposits, and they're never going to have to pay anything on them. I mean, just because of JP Morgan.
Well, they have non-interest bearing deposits for which they pay nothing. Yeah, but they also have interest bearing deposits, and the composition changes slightly from fewer non-interest bearing deposits to interest bearing deposits. And just to, I think I knew what you meant, but just to explain for the audience, if they own a ton of long-term bonds, agency mortgage-backed securities, the value of those will go down as interest rates rise, and at least some percentage of those they'll have to mark down. Available for sale, they'll have to mark the value of those down. But as interest rates rise, the value of non-interest bearing deposits is very valuable because you should be paying 5%, but you're paying nothing. But that's not being reflected in the balance sheet. It's being reflected in the income statement. Yeah.
Right. But just to finish the conversation, of the three of that Holy Trinity thing, this is the one that I'm least excited about. I think on risk management, you want to have energy. On a secular AI, whatever valuation you want, healthcare. My case for banks, now that we have this kind of peak reacceleration, peak higher rates, I still think that I look at the big banks. I think JP Morgan is going to be fine, and given where they are, but I don't quite imagine them leading the next bull market.
Yeah, got it. Thank you. And also in your Holy Trinity, it was financials, not banks. So of the ETF you mentioned, I think banks and regional banks were a small percentage. So there's insurance companies, Berkshire Hathaway, and stuff like that. Well, Vincent, thanks so much for joining us. People can follow you on Twitter at Vincent Deluard. Your reports are excellent. You're a fantastic writer with a great sense of humor. Where can they find those reports for StoneX?
So the best and easiest way is to become a trading client of StoneX. Just ask your sales rep. I mean, we're very active in, futures, stocks, bonds, ETFs, ADRs, commodities. So this is primarily for institutional clients there. And then if you're more interested in the research, Twitter, go to my Twitter handle, as you mentioned, Vincent Deluard. Under my pin tweet, there's a link to get a free trial of my work. We give this free trial to everybody. I try to watch my DM pretty carefully. My experience on Twitter has been extremely positive. I've met very smart people. You.
In my experience in pubs, I met you. That's clear. Okay.
No. I mean, people. Yeah, it's like I think we're excessively negative on Twitter. It's a great and if you've done right, it's a place for great conversation. Sometimes people bring things to my attention that I'm very grateful, and these things can come from all sorts of all ways of life. Just reach out, and I'll try to take the time and send reports, and I'll try to keep doing these interviews. I greatly appreciate the work that Forward Guidance has done. I think we had this explosion in podcasts and smart conversation that did not exist 10 years ago, and we're all getting smarter for it. So thank you.
Thank you, Vincent, and thank you everyone for watching.